There's a lot of spin out there. A lot of people trying to tell you inflation, it's not so bad. It doesn't really matter. I mean, my gosh, as you pick up the papers, as you go online, you see stories from the Washington Post saying Americans are just learning to deal with it. You see CNBC saying, you know what, it's no big deal. Well, you know what? It's still a big deal. Just look at the latest Gallup poll. It proves it. Americans can't manage this massive inflation, especially when their wages are not keeping up. And even if it goes down, it's still up. All right, year after year. Let's not try and put some fancy spin on this one way or another. Hello, welcome everyone. Good to have you here. I am Trish Regan. A reminder that portions of today's program are brought to you by Legacy Precious Metals. There's never been a better time to invest in precious metals than right now. So go to legacypminvestments.com for more. Again, that's legacypminvestments.com. So again, as we look forward to getting this number, there are those that are going to say, oh, you know what, it's only 6%, it's only 5%, it's only 4%. I'm sorry, guys. You know what? It's still that much more than last year. And yes, 8.5% was a decline from the 9 point something, but it's still 8.5% higher. And when you factor in the fact that wages have not gone up in a corresponding way, then it means, well, real wages are down about 3% from where they should be. So consequently, this is a real issue. We saw in a new Gallup poll that, in fact, so many people have pointed to it. And yet this is not what you hear from the mainstream media, right? In the mainstream media, they want you to think that it's no big deal. Washington Post just ran a story saying Americans were kind of getting used to it. Well, 56%, according to this Gallup poll, say they feel inflation. This is up from 45% in November. And of course, the truth is the people that are struggling the most feel it the most. So the Democrats are supposed to come in with this whole plan, right, to make the economy better. And yet they've done anything but, especially for the constituents that they say they are most trying to serve. Anyway, we'll see what the read is today. I don't think the Fed has any choice but to move aggressively on interest rates. I expect it will at least get 75 basis points. We should get a whole point, but they've got to manage this in a way that doesn't just devastate the economy. Already you're looking at home prices, which have declined pretty considerably. I mean, $403,800, $403,800. That is now the new median home price in America. And that's down from $413,800 just a short time ago. Some people say, well, gosh, we're up like what, 36% from 2020. Well, that gets me right back to where I started, which is that government has intervened in a way that has really had massive negative implications for our society. And I think it will be very hard to just, sweep under the rug. By printing so much money for so long, by leaving interest rates so low for so long, and by simultaneously sending out multiple stimulus checks. And by the way, there's a whole bunch more, right? College loans, forget about them. Biden's going to let you write all those off, or $10,000 or $20,000 worth anyway. All of this stuff has an implication, effect on the overall velocity of money, if you would, right? So the money supply has increased so drastically, which has led to all this inflation and thus those higher home prices. Well, now we're going to turn around and you get the Fed trying to suck everything out. We'll see how today's number maybe really affects them in that sense. But, any way you slice it, it's getting dicier and dicier. It's a good chance to kind of remind you about my friends over at Key City Capital, Charlie Dombeck, who runs the team over there, who aggressively looks for alternative investments so that you're not completely dependent on the stock market, which has shown us a whole lot of volatility as of late. I'm somebody who likes to sleep at night. So having that diversity in my portfolio is actually really helpful and really relevant. And I think is something that everybody should look at. You've heard me talk about gold a lot, of course. You've heard me talk about things like treasuries, because, hey, yields are going up these days. Well, what Charlie specializes in is asset-backed real estate. And so you can have these real estate investments, if you would, without actually having to deal with the maintenance on the house physically, yourself. This is what he looks at, and this is how he tries to help his clients have a broader portfolio. The reality is, even with real estate going down, And it's not going down as much in some of the markets he's in, only because of the sort of macroeconomic environment that, say, a Florida is in right now or a Texas is in. But even if you were to assume that prices would go down, given all this inflation we're seeing, rents keep going up, right? I mean, just look at what they're telling us in New York City right now in terms of rents. They've never seen such record highs. The rent is too damn high. All over the country, you're seeing these rents move higher, even if there's some softness in the overall real estate market, which is why I think if you're clever about this, or working with a good team, there's still a way to invest in real estate. Maybe it's a really good time, actually, if you can get something as prices come down. KeyCityCapital.com/Trish, Trish, my name, KeyCityCapital.com/Trish. And be on the lookout. Charlie's going to be on the show later this week. He'll talk some more about it. I do think there's a real shot we run into a recession that's bigger than the one we're in right now. Look, I mean, we've got 3.5% unemployment. It's not awful right now. It's not so bad right now. Is 3.5% unemployment? Hey, I'll take it. But I think the numbers aren't exactly as they appear, in that 3.5% is really not that representative, because a lot of people have just exited the workforce, or they've found other ways to get by in this sort of gig economy, if you would. They've also recognized how to get assistance from government. And there's been a lot of assistance from government since 2020. So I think that those are some of the factors at play that explain this lower labor participation rate. But the other thing going on is that we're still enjoying the benefits, if you would, of all that pent up demand that had been there and all the savings, right? It's wonderful that Americans save so much money. Of course, they weren't going anywhere, and the government was handing out checks. So yeah, they saved. And so consequently, people were in an overall better financial picture because of that. But when does that run out? When does that change? When do you see that the increase in prices overall in the economy, the increased cost of capital thanks to the Federal Reserve already, hey, you get the 30-year mortgage rate above 6%. Who would have thought we'd see that in our lifetimes, right? I mean, it felt like we were in that 2-3% zone forever. Anyway, there's a lot of factors at play that would actually act as a drag on the economy at, frankly, the worst possible time, because everything's kind of mixed up right now. It leaves me very nervous and hesitant about the market. I have said before, I think it's kind of a trader's market right now. So be cautious, be thoughtful, look for opportunities, but be well aware that it could be very challenging in the near term. Thank you so much for listening. Listen, we're going to have much more on this. Charlie's coming on the show later this week, so we can talk a little bit more about real estate and how it's all affected. We can talk about what exactly the Fed might be looking to do when it meets, of course, September 20th and 21st. And I'll be back with you here again tomorrow. Have a great day, everyone.